Have you ever paused to wonder what truly defines a company's long-term investment potential? Many might argue it's the dividend yield, historical track record, market cap, or even its free cash flow. While these factors are undoubtedly significant, there's one element often overlooked: the power of the brand. When you hear names like Apple, Coca-Cola, or Google, instantly, an image, a sense of trust, or even an emotion springs to mind, doesn't it? That's the essence of brand power. It embodies a company's reputation, the public's perception, and its widespread recognition. Understanding this concept can guide you to identify high-return investment opportunities and ensure your long-term success. And this brings us to moats. We know that moat is a deep, wide ditch surrounding a castle, typically filled with water and intended as a defense against attack. Now, you might be wondering, what exactly is a moat in the business context? It's a term popularized by Warren Buffett, refers to a business's ability to maintain competitive advantages over its competitors in order to protect its long-term profits and market share. Similar to how moat protects the castle from invaders, a company's moat shields its revenues and market position from competitors. The value of a moat can be summed up in four main ideas: standing out from competitors, keeping a strong position in the market, being able to set prices, and making profits over a long time. Knowing what a moat is, the next question is, how do we invest in it? Turns out there is one ETF just for that, the VanEck Morningstar Wide Moat ETF, symbol MOAT. This ETF, with its inception back on April 24, 2012, isn't new to the block. Boasting a staggering $10.5 billion in assets, it's a testament to solid investment choices. Peeling back the layers, you'll find its asset allocation both intriguing and reassuring. 20% in the crucial healthcare domain, 19% in the robust financials, 15.7% in industrials, a considerable 15.5% is vested in the ever-evolving technology sector, and 8.4% emphasizing consumer. Now, what truly adds to its allure is the strategic distribution. You'll observe that no single entity commands more than 3% of the fund's assets. Such meticulous diversification ensures risks are spread out, optimizing returns. It follows clear rules and invests in companies that have at least one of 5 competitive advantages capable of creating a moat. And those 5 are: 1. Intangible assets, think patents, proprietary technology, or unique branding. 2. High switching costs, ensuring customers think twice before moving to competitors. 3. Production cost advantage, making goods more efficiently and cost-effectively than competitors. 4. Operating efficiency, operating at an optimum level for its market size. 5. Network effect, the more people use a product or service, the more valuable it becomes. Later, I'll show you examples of companies that have these specific qualities. These traits safeguard a company's capacity to increase revenue while upholding robust profit margins. And just so we're clear, margin is like a simple way to measure how good a company is at making profits and managing costs. When a company has strong and high margins, it means they're really good at keeping a big chunk of their earnings as profit. This is a powerful combo that makes these companies a smart choice for long-term investments. The fund has a beta value of around 1, meaning it moves about the same as the whole market. The real question is, how does this moat factor influence the performance of our ETF? Let's pull up a comparison. Pitted against the S&P 500, our moat shines, overshadowing its performance by a whopping 45%. Just this year, amidst the market's bullish sentiment, it surged ahead by 3%. Rewind to the 2022 bear market? It stood tall, surpassing the S&P 500 by an impressive 2.8%. If you're still tuned in and finding this content valuable, please consider subscribing to Invest Growth Wisdom for more insights. Your support encourages us to bring more enlightening content your way. But numbers alone don't weave the entire tale. It's about understanding the nuances. Look at this data. It compares the yearly returns of the MOAT fund to the S&P 500. The cool part is that the MOAT fund did better in good years and also lost less in bad years. This means its past scores, like Sharpe and Sortino, are really impressive. A fund's high Sharpe suggests it's delivering returns without taking on undue risks. In this arena, our ETF touts a Sharpe ratio of 1.05, same with the S&P 500. This metric is really important. They tell us how much risk a fund takes to get its profits. Bigger numbers mean the fund is good at taking risks, while smaller ones suggest we should be careful. So, how does the fund pick its investments? It follows the Morningstar Wide Moat Focus Index. This index provides exposure to companies with Morningstar economic moat ratings of Y that are trading at the lowest current market price/fair value ratios. But there's a catch: the fund often changes its investments to match the index. This meticulous selection and reconstitution mean the fund exhibits a strikingly high turnover rate, 51%. To put it in perspective, the S&P 500's turnover is a mere 2%. So, what's the significance of this turnover? It denotes how frequently assets within a fund are bought or sold. On the bright side, it allows the fund to seize emerging market opportunities. But every silver lining has a cloud, and in this case, it's the higher transaction costs, elevating the fund's expense ratio to 0.46%. For every $10,000 you invest, the annual pinch is $46. And remember, these expenses are silently deducted, not directly billed. Peeling the layers of this index, it's split into two vibrant sub-portfolios of 40 stocks each, undergoing separate biannual rebalances. A dynamic dance of stocks entering and exiting, based predominantly on valuations, ensures this fund remains optimized. For instance, while a powerhouse like Nvidia might be ousted due to soaring valuations, it doesn't reflect a diminished moat. What really makes these companies the darlings of the index? It boils down to the quintessential 5 moat indicators. Remember, I mentioned before there are 5 key things that show a company's competitive edge. Intangible assets: these are the invisible shields, patents, copyrights, or even sheer brand strength. Pharmaceutical leaders like Pfizer revel in this advantage. High switching costs when moving away from a product or brand is a Herculean task, either due to financial or convenience constraints. Giants like Salesforce or Boeing embody this strength. Production cost advantages: the ability to maintain profitability either by outpricing competitors or by sheer cost efficiency in operations. Think Amazon or Walmart. Operational efficiency and margins: businesses that consistently showcase stellar gross margins and capital efficiency. Titans like Microsoft and Alphabet lead the charge here. By grounding their choices in these strengths, funds like the Morningstar Wide Moat Focus Index ensure long-term resilience and growth, offering investors a shot at sustainable returns. Network effects: a principle where every new user amplifies the value for others. Platforms like Microsoft Office and social media behemoths like Facebook are classic examples. As we wrap up, it becomes evident that investing, when armed with knowledge about competitive advantages, metamorphoses from mere speculation to a well-calculated strategy. If the world of moat investing intrigues you, you're not alone. Many seasoned investors consider it a cornerstone of their portfolios. Before we sign off, if this episode illuminated new facets of investing for you, show some love by hitting that like button. And if you're not already part of our community, hit subscribe to stay updated with Invest Growth Wisdom.